This chapter will be an introduction into managerial accounting, and then we will have a few more chapters after that in more detail about managerial accounting. So here are your learning objectives. And what we have covered up to date in your last class and finishing up the first part of this class was all financial accounting. So going through and creating our financial statements, our statement of cash flows, analyzing those financial statements and understanding all of the different accounting that goes into the balance sheet and the income statement and the journal entries. Managerial accounting is different. It's a more of a focus of inside the business. How do they cost out their products? How do they create budgets? How do they then analyze the variances within those budgets? So I always think managerial accounting goes best like in a manufacturing environment. Financial accounting, if you're going to be an auditor or like work at a CPA firm, you'd focus more on that financial accounting. And then even in corporate America, though, your CFO still is focusing on financial accounting to prepare the financial statements. So again, the financial statements are the main focus of financial accounting, where we've got external investors as well as the company management who look at those. They're prepared according to generally accepted accounting principles. We prepare them quarterly, annually, and we report the company as a whole. Managerial accounting is more management reports, like we're inside the company. What is going to help us actually do better in that company and be more efficient and have higher sales and that kind of thing? So management is who looks at it. It can be subjective, so our financial statements are not subjective. They need to be according to GAAP and very objective. So subjective would be like what specifically do we want to look at, or what specifically do we want to happen, and then kind of how do we analyze those reports. So again, very focused on what the management needs. Don't have to be done. Budgets are normally done annually, but the rest of these things could be done just as needed. And then sometimes, again, we could break it into segments because we may be concerned about departments or geographic areas within the company, not the company as a whole. So again, we talked a little bit about that. So again, we're looking at who looks at our financial statements: investors, creditors, government agencies, as well as the general public. They're released out there. Again, managerial accounting is more internal. So we may look at historical data as a measure of our past operations to see, have we made improvements? Do we need to make improvements? And again, we could put in some subjective estimates to say, well, what if we think revenues go up 10%? What's that going to do to our costs? Can we maintain the same building that we are in if our revenues go up 10%, or do we need to expand? Like those kind of things. And they'll definitely be used in our daily operations, as well as planning for future and then developing those business strategies. So like I just said, what if we want our revenues to go up 10%? How are we going to have that happen? That could be a business strategy. So unlike financial statements and financial accounting, we don't have to use GAAP, because again, we're looking at our internal, what do we do? How can we do it better? We don't have to have them monthly, quarterly, annually. Like I said, budgets are normally annually, but maybe that's the only one that we do at a regular interval like that. And again, we don't prepare it necessarily as a business as a whole. We're going to go down to look at specific products, specific departments, that type of thing. Okay, so then here they give us a chart of accounts. So we're within that company, so we could have a president or a CEO, and then we're going to have different senior vice presidents that are over various things. So we'll normally always have a chief financial officer, and again, these could be over different geographic areas or different parts of the business. So our senior VPs can kind of fluctuate again depending on the company. They're just giving us an example, but we normally always have a CFO, and then we always have a controller who then reports to that CFO. Again, here it just kind of gives you a little more details of those different organizational charts, kind of how people report up to various people. So again, I like to focus on the accounting though, because this is an accounting class. So we would have within that accounting type area, you could have the chief administrative officer. So like on the slide, we had the chief financial officer. We could have a vice president of human resources. And sometimes there's a vice president like of risk management, who I feel like kind of falls into a little bit of the accounting side as well. And then of course the controller, and then it would go down from there. So the controller is kind of that head accounting person, but then you would have like maybe an assistant controller, an accounting manager, supervisor, kind of goes down the level from there. So that controller is one of the highest levels though that like an accountant can get to, and they're going to focus on their procedures, their internal control structure, that they're following their generally accepted accounting principles. They'll be responsible for the budget, any other special reports. They'll oversee the taxes. And then what we're going to get more into in this class in future chapters is that cost accounting. So our management process, we have planning, directing, controlling, improving, and decision making. Here it is again, looking at it from like a chart type of a format, but our decision making, you can see, is kind of in the middle, and like communication goes in and out. So like if we think, okay, here's our results, we need to improve them, we circle back to making decisions, you know what I mean, then implement those decisions, and then we'll review them again. So again, there's a lot of circular references here because it's all a process of improvement. Planning is very important though in managerial accounting, and it does include creating, strategies and budgets and those types of things, and operational planning. So the strategies are more of those big pictures, and maybe those are the president, the vice president, maybe even the board of directors. They're going to set those big long-term strategies of the company. Then we're going to take those big long-term strategies and take them down into smaller short-term actions. What can we do to achieve those long-term goals? And then managers who run those day-to-day operations, they would be responsible for directing. So they need to keep production moving, so we don't have a lot of downtime, and that things are running efficiently throughout the plant. Then they give us an example of like a credit manager. So again, because every manager is going to have different responsibilities. A credit manager is going to be looking at what potential customers the business is accepting, and then determining, are they going to be paying their bills timely. Controlling is when we're monitoring those results, and then we're comparing the actual to the expected. So we had a plan, we came up with this strategic plan, and we thought this was going to happen. We put it into place, and then now we're looking at, well, what actually happened? So then you're going to compare the actual to the expected, and then see where like there were errors or where things did not go as expected. And then we're going to start looking into those. So we call that management by exception. So we're going to look at the areas that didn't quite come up to plan, and then try to improve those or make changes. And again, so continuous improvement. So always kind of looking at what we are doing, eliminating those problems that are coming up in the areas again that we're focused on, and then try to improve it. And then we'll circle back and look at it again and see if those improvements worked. And then decision making. So management is constantly making decisions. I mean, probably you could almost say every day, there's constantly things happening that you need to make a decision. What are you going to do? So you're directing the operational people, like plant, your equipment could go down. What do? You don't want to just have the employees sit there all day and pay them. You want to, figure out what else they could work on, or get that piece of equipment fixed as quick as possible. So those are all types of things, like just on a day-to-day basis, that they're going to go through. They could run into, okay, hey, I've got some bad product. Why is this happening? Go back and train your employees better. Kind of all that type of stuff. So there's so many things inside a business that that management has to make decisions on all the time. So then how do they use accounting in all of these different decisions and improvements and all that stuff? So we're going to get more into like this first bullet point that we are going to cost out the manufacturing of a product so we can determine what we should sell it for. So what goes inside the cost of a product, we're going to have direct materials, direct labor, and factory overhead. And those might be new terms to you. We're going to talk about them though in the next few chapters. So hopefully they'll start to make sense. But say I'm making a chair. So whatever goes into that chair, so say it's wood and it's fabric and maybe it's some bolts that hold it together. The wood, the fabric, and the bolts and a cushion, those are all direct materials. So how much do those cost to buy them all? And then you got your, like all of the items that you need. Then it's going to go out into like your assembly line. And that's where the direct labor comes in. So then they take all those parts, the wood, the bolts, the cushion, and the fabric, and they create the chair. So then now the chair is created and we can sell it. So then what do they need though in order to create it? They're working in a factory, they're working on an assembly line. They need electricity and they need heat, and you've got to insure that building, and you have to pay the supervisor, you've got to pay the quality control people. So all of those other people who maybe don't actually touch the product per se, but they're still necessary to get a good product, we consider that all factory overhead. So again, it could be people's salaries, but it also could just be the cost of maintaining that factory. All of that goes into factory overhead. And then we'll run performance reports where we can look to say, did we use the right materials? How many, like, so if we're making that chair, how many of those wooden legs did we scrap? Or did we ruin the fabric and have to throw it away because, it ended up cut wrong or went on the product wrong? Were there times that the assembly line went down because we ran out of the legs or we ran out of the bolts? So those are the things that these performance reports will print out for management, and then they can analyze them then to say, well, what could we do to speed things up, make things better? Maybe we could find better product that's a higher quality, or if quality isn't important, we can find cheaper products just to save our costs. So the management's going to kind of analyze all of those things. And then our ultimate goal is to price the product at a price that covers all those operating costs and expenses. So then we're actually making money. So I'll let you guys look over those examples again on your own. So they give us an example of a guitar. So we've got the wood, we've got the strings, we've got whatever this guitar bridge is. And then you see the guy who's cutting the wood out to make it into the shape of the guitar. Then this guy's assembling it, putting it together, and then there's our finished guitar. So again, similar to my chair example. So a direct cost is one that is specifically used in that product. So an indirect cost could be all right, so this doesn't, so I was going to explain an indirect cost, but it's not quite matching up the slide. So we'll move on to that one maybe in the future. But so what the slide is actually talking about is just basic costs. So the costs are what the company is paying to make that product. And we can assign costs to a cost object. So what I've been talking about so far has been a product. So like first I talked about the chair, the PowerPoint gave us the guitar. That is a product that we are applying costs to. We could also do it by sales territory, by geographic region, by department, by activity. So any of those things could be cost objects, and then we could group our costs in accordance. Okay, now this is the one that I was starting to talk about. So our direct costs are ones that would be traced directly to the cost object. So like with the guitar example, the wood, the strings, the little side things that you twist around, those are all things that are a direct cost to that guitar. Indirect costs are things that you can't specifically trace it to it. So like, for example, the supervisor of the production line, he may not have actually, he or she may not have actually touched the guitar. They were not direct labor, but they were necessary to make that guitar. There needs to be a production manager who's walking around and making sure everything is going smoothly. So then we'll put all those costs together and we will charge them off to the guitar. And again, we'll allocate some of the supervisor's time to that guitar. So again, we'll have the direct traceable costs as well as the ones that are not traceable but still necessary. So then that leads us to kind of how do we actually classify them? So these are called manufacturing costs. And again, we'll have the direct materials, the direct labor, and the overhead. And again, they all are going to go together though to make the cost of the guitar. So here again gives you different examples of that direct material cost. Like I said, the direct labor is really has to be like an integral part of that product, and it's really has to be like a person who's really kind of touching that product. So that's what I like to think about it. If they're touching the product and adding value to it, they would be direct labor costs. Overhead, again, here gives you another list of the different types of overhead that we could have. So heating and lighting are utilities in the factory. If we have any repairs or maintenance to the equipment that we're using, if we're paying property taxes on that building, insurance on that building, and then the assets that we are using, are we depreciating those and how much depreciation expense? All of those things are necessary costs to make that product, and they would be factored into the factory overhead cost. Then here it is even like our indirect materials, so things like things that we may have just supplies of, so like oil to lubricate, or like duct tape, or just things like that that we may end up using during the process, but we don't specifically say that's that, you know what I mean, that's actually attached to that guitar or to that chair or something like that. All right, so you look through those exercises. Okay, then our prime costs are our direct materials and our direct labor. Our conversion costs are our direct labor and our overhead costs. So our prime costs, again, are like maybe like if you want to think like lower level, then now we're working on the product, we're getting it to its finished point. How are we converting it from those prime costs to a finished product? Those would be what would be considered conversion costs. Okay, then product versus period costs. So the product costs are the things that we've just been talking about: direct materials, direct labor, and overhead. Period costs are things that are not associated specifically with the product. So like selling expenses, general and administrative costs, those are considered period costs. And period costs are just expensed as they're incurred. So again, here's more examples: advertising, sales salaries, commission, office salaries, office supplies, depreciation expense on those office equipments. Here's our overhead. Look up here again, just different examples of what is necessary for them to build these guitars and create these guitars. So our product costs are included in our inventory, and then they're charged out to cost of goods sold when we sell them. Our period costs are expensed as they're incurred, and they end up on our income statement. So here again shows you that kind of graphically, and then another example. Then sustainability, I do feel like this is a very important concept, and I feel like hopefully most of the corporations that work that are operating in the United States are focused on sustainability, that they have somebody who's looking at how can we do better for our environment, do better for the economy, and then again, that this company can continue on into the generations. So we want to be a sustainable company, and we want to protect our world that we live in. So here it gives you some different examples, like what can they do to be more sustainable. And again, I sincerely hope that we are all supporting those types of like even governmental actions that are that are focused on sustainable energy and sustainable businesses. And especially in today's world where we have so many natural disasters and just crazy things happening, anything that we can do to help our environment, I think is a great thing. So then how does that go back to our managerial accounting? So again, helps us make those operational decisions to increase revenues, help us control costs, use our resources more effectively. And there is a sustainable accounting standards board that will help companies make those sustainability type decisions a little bit easier. And then there's different efficiency measures. So how can we be more energy efficient? So maybe there was a period of time, maybe 10 years ago, that all factories were switching out from fluorescent lighting to the lighting that shuts off when you're not in there. So it's going to sense movement, it's going to turn on. So think if you're in a big warehouse, you don't need all those lights on all the time if nobody's out there, but as somebody comes in, boom, the lights pop on. So that was something that maybe like about a decade ago, most big companies did away with all their fluorescent lighting and replaced those. Again, we don't want to waste materials. There's not just from an economy level an environmental level, but even just from a cost level, the more materials you waste, the more money you spend. So that's not efficient. Fuel, so maybe we can try to come up again with more energy efficient type vehicles, ways to generate electricity if you're in that type of an environment. So anything that again is going to be more like producing less of that carbon dioxide and that type of thing, just to get safer and better. And then eliminate the waste that, especially if it's almost like pollution type wastes, eliminate those and recycle and reuse and get better with our waste that we're dumping into our environment and our rivers and all that type of stuff. So from a financial statement standpoint, it's very similar to what we've done in our past chapters, but they can be there's a little bit more complexity related to those product costs. So now we look at inventory. So instead of just having merchandise inventory like we've had up until this chapter, now we break our inventory into 3 categories. So we have our direct materials inventory, our work in process inventory, and then our finished goods. So if we think of the guitar, the wood and the guitar strings and whatever else the little twisty things were, those would be in our material inventory. Then as it's touched, so as the guy cuts out the shape of the guitar and then we start to assemble it, it's not done yet though, we're still working on it, that would be considered work in process. So a little bit of labor has been done. It's been converted a little bit from direct materials into a finished product. Then when it's all done and we tag it up or seal it up, then it goes into our finished goods inventory. So again, here they show you a comparison. So before we just had merchandise inventory, now we have a little more detail. Finished goods, work in process material, and then we carry that total out to the right. The income statement will have our cost of goods sold. We may have to calculate that. So we'll first look at, what was our, this is showing you again what we had in our merchandising one. So our merchandise available for sale, our beginning merchandise inventory plus purchases gives us our merchandise that's available for sale. We then looked at what's left in our ending inventory, and then the remaining would have went out to cost of goods sold. Now for a manufacturing business, you can see it's just a little bit more advanced. We still are getting to the cost of goods sold number, but now we're going to have a beginning finished inventory. We'll add our cost of goods manufactured, and then we will have our cost of goods that were available for sale. So again, beginning plus what we completed during the period gives us what's available, less the ending, and the rest charges out to cost of goods sold. So again, here it shows it kind of in a formula, but again, beginning finished inventory plus our cost of goods manufactured gives us what's available. Subtract out the ending, and that goes to our cost of goods sold. Now, there is a statement of cost of goods manufactured. So this could get a little bit more detailed. So here they show it to you. So we have our beginning work in process inventory, and then we'll calculate out what direct materials did we use. So what was our beginning? What did we purchase? What did we have available? Then we go out and we take a physical count of those direct materials and we subtract those out. So that's our cost of our direct materials used. What was our direct labor? Again, who the assembly people were, the production people. We allocate overhead to the product. That's going to be our total cost of goods, our total manufacturing costs. And then that's going to go into our work in process. So then we'll have those total manufacturing costs less our ending work in process. And then that gives us our cost of goods manufactured, which then is what we go into to determine our finished goods. So it goes from our raw material inventory into our work in process, into our finished goods, and then into cost of goods sold. But they're kind of all analyzed in that same way. So a little bit more details and maybe a little bit more confusing, I guess, than a merchandiser. So again, here it shows you the different types of inventory, the manufacturing cost incurred, to come up with the total. So again, the flow of it is showing you if we haven't done anything with it yet, those direct materials are just in materials inventory. Once we start to use them and they go into the manufacturing process, they go out onto like that factory floor, you'll have direct materials, direct labor, and factory overhead. It'll be being converted. Those are our conversion costs. And if they're not done yet, they'll stay in work in process inventory. If they are completed and finished, they'll go into our finished goods inventory. And then we'll see how much got sold and get charged out to cost of goods sold. So that's a good graph to kind of see all the different categories. And then here shows you that cost of good manufactured in a nice step-by-step basis. So you can look back over that as well. That should help you. And then here it's showing you how then that cost of good manufactured goes into our income statement as helping us calculate out our cost of goods sold, which will then be reduced from our sales to give us our gross profit. And then there's an example exercise you can also look over. So that is our introduction to managerial accounting. And again, we'll have a few more chapters where we'll get into a little more detail on that costing.